He's Guy Spier, CEO of Aquamarine Capital Management. He joins us now live from Zurich. Hi, Guy. Guy, rarely have I heard such superlatives. Humongous, hog heaven. It sounds like a Christmas feast. Just explain the thinking behind these superlatives.
It might be Christmas cheer, Mark, that's bringing me to that. But we've had a decade of terrible equity returns, and we have an unusual inversion that I think is rare in financial markets, in which these great companies are trading at yields which are much higher than government bonds. It should usually be the other way around. And we have so many things that are poised to turn around. And we have markets which are very focused on much of the negative that's here today. But the minute that people look up, I think that we're going to have a massive shift. And that will happen with the US election. It'll happen with the housing market in the United States turning around. It will happen with banks eventually getting their balance sheets in shape. And of course, it'll happen when the euro finally gets sorted out, which it will. We don't know when, but we know that it will. And once all those things are behind us, it's going to be plain sailing.
I mean, give me sort of figures, Guy. You know we like specifics here. You've got to quantify it. I mean, what sort of equity rally might be on the cards if the stars do align, if all those factors do come into play?
What I should tell you, Mark, is that I can't guarantee to you that it'll happen in 2012 or whether it'll happen in 2013 or 14. But I'm talking, we will see years where we have easily the main broad indexes up by 20–30%.
Wow, that's big. I mean, you've put your neck on the line, Guy. You've talked about dividend yield. That's important to you. And you've listed some companies. I'm just going to rattle through a few, and you can eulogize as much as you wish. I mean, in Europe, you like Tesco, you like Nestle, Reckitt, and Unilever. What are the factors, the common factors that attract you to these types of stocks?
Mark, allow me just to correct you on one thing. Eulogize would not be the word that I would use because it implies that they might be going downhill.
Oh, okay.
These are all companies that are some of them are more than 100 years old. They've lived through a couple of world wars, many other crises, and they're making household staples. They're making the detergent that my wife uses at home. They're going to be around a very long time, and they're all inflation-proof. And so we can pick these companies up at very reasonable multiples. They're global businesses. They benefit from emerging market growth. They can handle a slowdown in Europe. It's often less than a third of their sales. And they're just great things to put in the portfolio and go to sleep on.
And can you go to...
And what's interesting...
Go on, Guy, go on.
Go ahead. What's interesting is that all of these bond investors who've suddenly realized that Italy may not be a good country's bonds to own are running to countries like the UK and Germany. Why are they not reallocating to equities? I believe that next year may be the year that they do that.
You touched on banks a little earlier, Guy. You said that if they sort themselves out, that's part of your sort of scenario to get into stocks. I mean, it's a big if, and are banks at this stage attractive on any sort of basis or not?
I've said before, European banks I have a harder time understanding because I think there's a lot of politics there. I think that the European money center banks, when you look at any measure of what the normalized profitability would be based on their balance sheets, I think they're extremely cheap. And what people aren't paying attention to is that right now, Basel III, Frank Dodd, they're obviously having their wings clipped massively. But I don't think people realize that the regulatory regime is a dynamic process, and inevitably after a crisis they're going to have a tighter regulatory regime, but that is not fixed in stone. And over time I think that many of the money-making activities that they're being restricted from right now will be allowed to them again, and that will result in a very long wave of maybe 15 to 20 years of increasing ROEs and increasing profitability. So I really think that we're getting some very interesting values, and you talked about Bank of America being down 50%. I don't think they're going out of business.
Guy, thanks a lot. Have a good Christmas. Thanks for joining us today. Guy Spier
Thank you, Mark.
from Aquamarine Capital Management.